Welcome to this week's episode of We Got You Covered on RVN TV. With us today, we have Joel Horowitz, and our episodes each week focus on insurance. It could be employee benefits, life disability insurance. This could be for insurance agents to receive some information, and it can also be for employees that want to have a better understanding of benefits and insurance that are available to them either outside the workplace or within the workplace. So again, with us, we have a very dear friend of mine, Joel Horowitz, 35-year private practice attorney, specializes in employee benefits and executive compensation, has his Master's of Law from Georgetown University. He spent 4 years in the Chief Counsel's office at the IRS, and I had the privilege of meeting Joel about 20 years ago. Today's version of the FSA or flexible spending account or HRA or HSA debit card, which many of you may be familiar with, Joel was a pioneer from a legal standpoint with the IRS on getting them to approve it and understand it and how technology has come into today's employee benefits world. So Joel, I consider you the go-to guy when it comes to Erisa and anything IRS and compliance related. And I know you spent the last 14 years McCarter English, and you've also been a keynote speaker at a lot of insurance conferences across the country. So to say that you're a foremost expert is absolutely an understatement. So with that said, today we're going to talk about federal compliance and employee benefit programs and from a legal standpoint. So from your point of view, what are the big compliance issues or the top compliance issues that employers are facing today relative to their insurance and employee benefit programs?
Thanks, Robin. Thank you for the gracious introduction. I was going to say, on my way over, I was thinking about how long we've been working together, and the word. So we'll engage in a little log rolling here because I was thinking that you, Rob, were a real pioneer in the area of, in particular, flexible benefits administration. And we were talking about debit cards for flexible spending accounts, in particular, 30 years ago. Way before they were ever considered seriously by other third-party administrators and before the IRS thought about it seriously. And so you've been a real pioneer in that area, and it's really been a pleasure working with you all that time.
Well, the interesting is when we started talking about that back in the late 90s, you and I, today it's the standard. If you don't have that debit card for some type of insurance reimbursement account, whether it's a health savings account, health reimbursement account, or flexible spending account, you're really behind the times. And back then when we were talking about it, people said it will never happen, you're crazy, the IRS will never approve it. And really, if it wasn't for your efforts and your outside the box thinking and your intellectual property on employee benefits, it probably wouldn't be where it is today, streamlined.
Well, you're very kind. It seems it's almost like we were, back then in relative terms, we were all driving Model Ts. We just didn't know it at the time because the standard was you had to get a piece of paper, get it stamped okay to get reimbursed for flexible spending. And now you walk into the pharmacy or a big box store or your physician's office and you give them a debit card and that works. Now it's important to make sure that there's a compliant debit card. And so almost any time that somebody is delivering third-party administration services, it says we'll provide a debit card. And it's important to write into that contract a compliant debit card, one that satisfies what the IRS is looking for to make sure that it works. And that, as a matter of benefit administration, it's virtually malpractice, as you put it at this point. It's not just the standard, it's malpractice not to have a card that does not comply with the IRS rules. So as far as participants are concerned, this is a no-brainer. It's very simple, it works beautifully, and you were really a pioneer and a leading expert in bringing that to
I appreciate that.
Bringing that to life.
Certainly, if it wasn't for our friendship and partnership at the time, it wouldn't have come to fruition.
And I appreciate the fact that this was the unrehearsed part.
That's right, that's right. No, I appreciate that. But we're really here to talk about Erisa, which is the Employee Retirement Income Security Act of 1974. It is a federal regulation. And Joel, for the most part, even though it has the word retirement in it, and initially it was to help regulate defined benefit pension plans that are really not in today's world, but a lot of people still have access to them, unions and nonprofits. but ERISA really covers a whole array of federal compliance and obligations for employers. So when we started out with the program, we said that you were going to focus on what are the top compliance issues or regulations that employers are dealing with today that are a challenge to them, or things that they don't understand, or maybe things that you're getting calls every week, hey, help me with this, help me with that.
Well, they fall into three or four categories, some of which involve ERISA, and we'll circle back with ERISA momentarily, but certainly ERISA's fiduciary requirements and standards for treatment of people under their pension plans, 401k plans, and their health plans, to name three in particular. So it's an important rule, and we'll circle back with that. Certainly employers have significant compliance obligations and questions all the time, and sometimes confusing letters from the IRS about the Affordable Care Act because the failure to meet the employer mandates, things that the employer has to do to cover the right people, to determine whether they're covering the right people and providing the right benefits or offering the right benefits, can get very expensive if you get it wrong. A third one is voluntary benefits. When an employer invites or accommodates a broker, a provider, a vendor into their office to make available for sale voluntary benefits, disability insurance, an whole range of insurance, but may have nothing to do with employee benefits. It may be homeowners. It may be all sorts of things that are not traditional employee benefits. Whether the employer has any exposure, and what does the employer have to do to make sure that they are not seen as endorsing that, and how do they avoid liability while still offering that kind of opportunity for employees. So I think those are three or four of the big areas.
So you're saying the Affordable Care Act, or Obamacare, however we want to define it, the legislation was passed in March 2010, I believe. And you're saying that 9 years going on 10 years later, employers are still dealing with understanding and compliance with the Affordable Care Act?
Absolutely. The good news is that the vendors for employers, their advisors, their administrators, health insurance brokers, consultants, and their lawyers have figured it out. And so for the most part, an employer should be able to rely on their broker primarily and their accountants primarily and an administrator to make sure that they're getting it right. But there's some misconceptions in terms of who has to be covered and who doesn't have to be covered, and there's some misconception that the employer has to pay for the health insurance for the employee and their families, et cetera, and that's all wrong. The problem is that if you get it wrong, you get a letter from the IRS, and they started issuing these with respect to 2015. Those started first showing up in early 2018. It took the IRS that long to audit 2015 compliance, and you get a letter that you could make a small mistake, and then an employer that has, let's say, a couple hundred employees, not a very small employer, but not a 10,000 employee company, an employer could get a bill, as a couple of our clients did, could get a bill for in excess of $200,000, $300,000, where they didn't know they did anything wrong. Fortunately, sometimes the issue is one of checking the right boxes and keeping an eye on the tax returns and the information that's submitted to make sure that it's done accurately. So fortunately, we were able to help them get out from under that. But sometimes the employer provides the wrong benefits, and there's only a little bit of leeway in the law to get out from under that. So it's important for the employer to understand what they're supposed to be doing, who they're supposed to offer the coverage to, and what kind of coverage that has to be.
You bring up a good point. When we use the word IRS, everybody says, oh my gosh, the IRS, I should be afraid of them. And I've never been afraid of them, as long as you're willing to work with them and you showed them, listen, I tried, or I didn't understand, or it was just a mistake, and so forth. Usually they're forgiving, if there's a penalty involved, a lot of times they are forgiving and saying, listen, if you could correct the error or the omission or the mistake, as long as you're compliant moving forward, we will forgive you at some point. Do you see that, where the IRS can really be friendly to you? They're just doing their job.
All the time. Interestingly, In this whole employee benefits field, the IRS recognizes that it's ridiculously complicated, that it's easy not to be in compliance. In fact, it's hard to get anyone to certify and give you an opinion that you're in compliance on everything. But the IRS figured out that in certain areas, such as with respect to 401k plans, if you make little mistakes running the 401k plan, it shouldn't result in the entire disqualification of the plan, because who does that hurt? It hurts the employer, and more so, it hurts the employees who don't get the benefit of being in a compliant 401k plan working the way it's supposed to. So the IRS has come up with, from time to time, programs that basically say that encourage the employer to identify mistakes and only penalize the employers that don't identify mistakes. And so the quicker an employer is to figure something out and fix it, the gentler the IRS is with those employers, and as well as the Department of Labor, which also has something to say in this area, which is sometimes confusing. But both the IRS and the Department of Labor have programs that basically might be very large penalties and make them very small, and sometimes simply permit the employer to self-correct. That is, you fix it and forget it.
Beautiful. Well, it's that time of the show where we have to have our break. When we come back, we're going to be continuing to speak with Joel Horowitz on Erisa and other compliant issues that employers are facing with their employee benefit programs. See you in a few.
Cook or just want to eat like one, visit Rostelli Market Fresh, your home for the freshest locally sourced ingredients to please everyone who loves great food. Our organic meats, quality seafood, and free-range poultry are cut fresh to order. Chefs create culinary-inspired prep foods made fresh every day, which pair nicely with our vast selection of fine wines and spirits. Choose from handmade pastas, artisan cheeses, organic produce, and grocery items, all from the finest purveyors. Rostelli Market Fresh, from our family to yours.
RVN TV is a platform for people of any industry to share their story. Over 285,000 viewers are tuning in to RVN TV shows monthly. We guarantee a great experience that you'll be sharing with everyone you know while increasing your personal and company's brand awareness. But what is your brand? According to Forbes, it's a combination of your logo, your product, your design and feel, and your personality. Did you know that aside from being a guest, we offer even more opportunity to boost your brand? Adding your company logo and website on screen during your interview will allow viewers to recognize your brand instantly. Incorporating images and video clips is another great way to showcase your product during your live segment. Let viewers see how good you really are. And most importantly, there's you and your interview. For less than the cost of a newspaper, direct mail, or a magazine ad, you can leave our studio and within 48 hours have a permanent digital copy of your live segment to link to your social media, embed into your company website, or use in email marketing. Investing in your brand is so very important, and we can't wait to have you as a guest.
We got you covered. I'm your host, Rob Shestack, and I'm here with Joel Horowitz. And we've been talking about Erisa and federal compliance obligations for employers. And we were talking more high level before we went to the commercial break. So Joel, trying to wheel this all in, what does Erisa mean? Why do we care? And how does this affect, let's just say, 401k plans for employers today?
Based on what most employers have heard, they wouldn't believe it when we say Erisa really isn't all that complicated. Erisa is a statute that was passed enacted in 1974, signed into law on Labor Day in 1974, that was designed to protect employees, both with respect to their retirement accounts, as you point out, but also with respect to other employee benefits. The Erisa fundamentally is all about fairness to employees. It came about in part because employees sometimes were promised things that they didn't get. Pensions that employers promised, and they might have been well-intended, but the money wasn't in the bank. Or they may not have been as well-intended. They made promises that they didn't stick to. But the law goes farther than traditional pension plans. It covers 401k plans, it covers health insurance, and other employer-provided insurance. And primarily what it does is it's designed to make sure that employees are treated fairly by their employer, both in terms of who gets to participate in the plans. Erisa requires fairness in coverage and fairness in eligibility as to who gets to participate, as well as how you're treated when you're in the plan. Fairness with respect to employer contributions, fairness that is, you can't discriminate in favor of non-highly compensated people. You can't discriminate against the rank and file. And then also in claims. You can't pick and choose what kind of claims you're going to honor. Everybody has to be treated fairly, and there's claims process. But the devil is in the details.
So ERISA not just covers retirement plans, 401k plans, pension plans, and so forth. It covers medical plans and other insurance programs that the employer pays for. So you made some very key points where, with regards to the fact it protects the employee from not paying claims, giving them their benefits when they're due and when they're promised, and other obligations. Over the years, when I talk to employers, they say, oh, ERISA, we don't want our plans to be ERISA. It's too complicated, and we don't want to be involved with that. And I've always taken the approach is, no, ERISA is not complicated if you have the right advisor, and it actually helps both the employer and the employee. So it's kind of a law that blends the two together and says, we're here to regulate and help both sides of the table, both employer and employee. So from an employer standpoint, why does it matter for ERISA, for them to be under ERISA? And is it really that complicated to comply?
Well, as a practical matter, the employer really doesn't have a choice. Because if the employer wants to have a 401k plan or a health plan or both, much less anything more arcane or complicated, all kinds of insurances and things, if they want to have a 401k plan or health insurance plan, or a health benefits plan, it's going to be covered by ERISA if it covers anybody other than a standalone self-employed owner. So the idea is, again, that rank and file employees are going to be covered. Now, is that such a bad thing for employers? No, because your advisors know how to take care of this. It's not easy for an employer that's simply trying to run its business to get to be an expert in terms of that area of satisfying IRS and Department of Labor rules, the compliance rules, but your accountant does. Your broker does. If you have a lawyer that works in this area, they do too, if it's somebody who practices in this narrow area. And that goes to the issues primarily of what has to be filed and when, and what kind of information do you have to give to employees. It's not that hard. Everybody has a compliance calendar, and it's fairly straightforward. It's not really easy to do by yourself.
Well, it's interesting because you did say an employer, whether they want to or not, if the plan is subject to ERISA, they have to follow the law. They can't say, oh, we don't want to be subject to ERISA, even though they don't have a choice. They either are or they're not.
The only kind of plans that are not subject to ERISA basically are deferred compensation plans for owners, for high-paid people, and also standalone pension-type arrangements or insurance, again, for an individual self-employed person. Once you start covering employees, it's going to be subject to ERISA. It's federal law. State law doesn't get involved unless it provides better benefits to the employees than the federal law does. So you're going to be in ERISA.
So with that said, it sounds like if the employer is involved with the insurance programs, it's subject to ERISA. Now, I do know if the employer is paying part of that premium, it's ERISA. It's clear cut. If I'm paying for any portion of your medical or dental or other types of benefits, they have to be covered. They have to comply with ERISA. Now,
that's right, and the compliance isn't that hard. It's basically a couple of annual filings and giving people the information that they're entitled to, and not interfering with their rights. But even if the employees pay for the whole portion, pay the entire premium, such as a standalone 401k plan where employees just contribute, or health insurance that the employees pay the entire premium, that is going to still be an ERISA plan.
And why is that? Because it's employer sponsored?
Because it's employer sponsored. Because the employer's involvement, it arises because the employer is sponsoring or maintaining the plan, and that's the magic language.
Is there any times where, like voluntary benefits, say voluntary critical illness or hospital indemnity or a limited medical plan, where the employer doesn't pay any part of the premium and they say, I don't want this subject to ERISA, Is that possible for an employer to avoid that?
It's absolutely possible. This is fairly well-developed law, so there's some bright lines of do's and don'ts, only a little bit of gray area. And so if the employer is simply accommodating the employees and the providers, let's say a broker or a vendor that provides any kind of voluntary benefits, homeowners insurance, cancer insurance, all sorts of things that might be available in the market, the employer can accommodate, as a convenience for the employees really, can accommodate the vendor and have them in, give them a room, give them, publicize the fact that the broker or the vendor is going to be there. The employer needs to stay out of administration of the arrangement, and the employer should be careful not to overtly endorse the arrangement.
Can they do payroll deduction?
They can do payroll deduction.
Is that considered administration?
No, it's an accommodation that the employer may be engaged as, again, as long as the employer is not endorsing and establishing the program, then the employer can get involved in payroll deduction and providing facilities, even making available documentation, handouts, flyers that making available, not necessarily mailing them to people's homes, but making them available.
But at the end of the day, even though the employer in that regard on those types of benefit programs says, I have the opportunity of not having this plan under ERISA, is that really advantageous for the employer to take that approach?
Cuts both ways. The employer, some employers will simply say, I don't want the additional involvement. The issue with an ERISA plan might be the suggestion that the employer is endorsing the coverage or endorsing the product, and then you get into whether it's been appropriately selected. Have we invited in the right guy? Have we, what's the quality of the insurance company that's providing the coverage? So employers might be well advised not to cause it to be an ERISA plan, because then they're not going to be held to that standard.
Let's go back to that for a second. So you're saying if I'm an employer and my insurance broker or consultant says, here are three choices, A, B, and C, and the employer says, I like B, but I don't want to be involved, that is them being involved.
That's being involved once the employer gets involved in choosing who the provider is going to be and what the coverage is going to be, then they're at least open to the claim, to the suggestion that if something goes south, that they are going to be a defendant in a lawsuit, or they could be. But if they simply, again, make facilities available and invite a broker in and say, look, this is for the employee's convenience, then under established law, they're in the clear.
Wow.
Or should be, at least.
So it can be very complicated, but very simple at the same time.
Right, and I'm not suggesting anybody in particular, but you know this area, and employee benefits specialists, not necessarily every accountant and every broker,
right,
but employee benefits specialists, in most cases, if they're involved in the voluntary benefits area, they know the drill. And it's in their interest to make sure it works right. So
the one thing that I do know, and just confirm this from a legal perspective, is let's say the employer has the opportunity to say, I don't want it to be ERISA, and I do. And let's say they choose, they don't, and it's very clear that it's not going to be an ERISA plan. And then at some future point in time, they say, okay, I want it to be ERISA for whatever reason. Mm-hmm. Can they go back and say, well, next year I don't want it to be ERISA? It's hard to go back and forth. The idea, there's some sense of permanence here, that once, especially even that, the implication is that it's an employer-sponsored plan because you're going back and forth. It recognizes that the employer is involved. What we're trying to do here is say, if you don't want to be covered by ERISA, then it's kind of a hands-off. Come in, use the room, happy to help you, happy to accommodate you, but that's that. Now, they may want to be covered by ERISA because two things happen. One is there's an implication, an inference by the employees that the employer is doing something valuable. The second is, if it's an ERISA plan, if there's ever a claim, the claim is brought by the employees, has to be in federal court, and that's a technicality, but that is a higher bar for plaintiffs' lawyers are almost always
would try to avoid federal court. It's more expensive, it's more complicated. You're invoking Erisa, which is not a simple contract issue in state court.
But in federal court, they can only sue for the value of the benefit. They can't sue for compensatory or punitive damages?
Generally that's correct, unless there's a fiduciary breach.
Okay.
And then the Department of Labor has published rules, and under the statute, that so that you don't discourage people from bringing claims, that if there's a breach of fiduciary obligations, which again is a fairly high bar, and it's not just we didn't, as it turns out, we didn't pick the best insurer. It's more like you really did something wrong as a fiduciary matter. In that case, there are potential damages available for the.
And that could be in a self-insured plan, where the employer or the senior leadership executives are the fiduciary, and then they say, you know what, don't pay this claim on Mr. or Mrs. Smith, and then they find out that they should have paid the claim and they didn't. That's where they're violating their fiduciary.
Well, certainly, even in the self-insured plan, just like an insured plan, those are subject to Erisa, and absolutely, it's a matter of, if there's one thing that employers need to know, and that it's what are my obligations. It's not just a matter of being well-intentioned. It's a matter of being educated or hiring people who are to advise what's my obligation to my employees under those circumstances.
So at the end of the day, Erisa really helps the employer and helps the employee, protects both sides under different circumstances.
It was designed to protect employees. What employers get out of it is the fact that it limits claims to federal court claims, and it also sets forth a whole claims procedure.
And a higher bar.
And a higher bar that you have to go through before you can even get to sue to get into court, which is why there are really very few Erisa cases in relative terms. And then the second thing it provides is certainty. You don't have to guess what the obligations are because they're laid out for you.
So if you're an employer, don't avoid Erisa. Erisa's your friend. I always said that. Erisa was a friend of mine in high school, and it could be a friend of yours in the employee benefits
You may not
space.
be able to avoid Erisa, so you might as well get to like it.
All right. Well, we're almost out of time, but I do want to touch upon one thing real quick. What are the penalties? So if somebody doesn't file the right forms with the IRS, what are some of the penalties that can be incurred by an employer under Erisa?
Well, there's an annual filing. Not to get too granular here, but you're familiar with it. It's a Form 5500 for any employer-sponsored plan. Basically, any employer that has a 401k plan or a pension plan or anything like that not only has to file, but they probably hired an administrator that knows you have to file. And the penalties can be pretty severe if it's not filed. If you discover it's not filed, there's something called a Delinquent Voluntary Compliance Program with the Department of Labor, that if you come in and say, mea culpa, I forgot, I didn't know, I didn't realize, et cetera, it's actually remarkably gentle. So that while it sounds like a lot of money, the penalty is limited to $2,000 per delinquent return for no more than 2 years. So that on something that could literally cost $50,000, 5-digit thousands, 6-digit thousands for, in the worst cases, if there are lots of plans and lots of delinquent returns, you might limit your exposure to $4,000 a plan.
Well, Joel, we're out of time. I'd love to have further conversations with you, especially when it comes to fiduciary responsibilities. So with that said, can you tell the viewing audience how they can reach you if they have any questions?
Call Rob. he has me on speed dial. It's very nice. And he has my cell phone. This, however, is my office number, which is 215-979-3830. And my email is jhorowitz@mccarter.com. And thank you for asking.
Thank you, Joel. Thank you for allowing me into your homes every week, especially today. When you have a chance, pay it forward. Have a great weekend, and we'll see you next Friday on We Got You Covered. Thank you.